Good evening, a very warm welcome to this edition of India Tonight. I'm Vikram Oza, and we are tracking all the big developments of the day on the news front, whether it's the markets, the equities, and indeed what's happening as far as corporate developments are concerned in the world of entertainment and sports. We have it all packed in this 1 hour here on India Tonight this Thursday. But first, let's get on with the big story tonight. It's about the sell-off that seems to be continuing on Wall Street. US weekly jobless claims are rising. They've risen to 218,000 last week. The number is above estimates of 200,000. That's where estimates were pegged. Now, indices on Wall Street declining. Markets have opened there, and we've seen the Dow Jones down about 300 points or even over that. The S&P 500 is hovering around bear market territory. It's down around 20% from the all-time highs it's seen. And recession fears are clearly spooking investors. They're waiting for the Fed's commentary, and that's going to be aggressive by most accounts. Big tech stocks remain under pressure, investors moving away from high-ticket items that provide low returns. The NASDAQ, on the other hand, we are currently watching. It's taking less of a hit than the other indices as we speak. It's still up. It's managed to stay up by about a fifth of a percentage point, now about a quarter of a percentage point. But the Dow Jones is down close to a percentage point. And yes, the S&P 500 as well. It's down about 0.4 of a percentage point as we speak. So let's get perspective on this. Manish Singh is the Chief Investment Officer at Crossbridge Capital. Let's understand the markets and the way they're behaving right now. Great to have you with us, Manish. The fear of the Fed going in for an aggressive stance is clearly weighing on the markets. Fears of recession are very strong as well. In your opinion, what are the markets going to react to the most now going ahead from here?
I should say that it is all down to the CPI number. Everyone is looking at the CPI number. Last print, as you know, was at 8.3%. However, a lot has happened. You saw the earnings yesterday from Target and Walmart, which is clearly saying that consumers are not going to pay higher prices. So the market is doing a lot of tightening for the Fed. Fed has done some tightening. The fall in equity market is doing some bit of tightening on its own, as in terms of wealth effect. But if there's one thing you have to look at, you have to look at the CPI number. That is something that you have to keep looking at. If that starts receding down, and by which I mean the second order effect, it's still high, 8.3, but if that keeps coming down, then I think you will see far more calm in the market. I should say that market is oversold, but nobody rings the bell at the top, and so nobody's going to ring the bell at the bottom. You have to just pick the things that you like, that you want to hold for long term, and there are plenty of such trades out there.
The pockets that you believe are going to hold out, because right now we are seeing a certain amount of tech stocks that have gone out of favor back home in India. But when you look at the US markets and the kind of fears that are looming large, if you want to play it safe, which are the pockets you would look at?
Well, I'd say that if you are looking for safety, then the safety always has been through the healthcare names and consumer staples name. Having said that, you saw how the consumer staples stock sold off yesterday. What I would like to point out that the QE has distorted the market. The idiosyncrasies effect that you used to have in the past, when people look at equity and value the equity for the sector it is in, that has disappeared to a large extent because everything has been driven by headline, what you call the macro factors. So if the market is down, then all the stocks are down. You can't find any stock which is not down. Now, I hope that clears up, but that'll take a bit of a time, given that we've had almost such a long time of QE. And even though the QE happened mostly in US and Europe, I think this has distorted the global market because of capital flow, which happens everywhere. But again, if you're looking for defensive name, then you come down to utility, come down to healthcare, come down to some strong consumer names, which are going to hold off because people are going to keep buying the essentials.
And among the emerging markets, how does India really stand in your opinion? Because there is a certain amount of correlation that we've seen in what's happening in the US markets by way of recession fears, inflation worries. So in that, how do you think India is likely to perform from the short to the medium term?
See, I would say that India will continue to be a very attractive market, and that is for the reason of of growth and the amount of growth that can happen in India. You're also seeing that India is benefiting from the comparative energy prices. I know energy prices are high, but given that how Russia has to sell energy to emerging market more than to Europe, which means that the energy prices are not as punitive as it would have been in other circumstances. So I think that plays another part as well. And of course, there are lots of reforms that Indian government is carrying out. I always say that, if you look at the market from 2 to 5 years point of view, you just can't ignore India, just purely based on what is happening from not just reform front, global front, capital flow. You know this better than me that the domestic investors are putting a lot of money into the Indian market, which is a good sign. So you don't rely on capital flow from outside. So there's plenty of things going on good for India, and you have to basically take a medium to long-term view, and what we like to call dollar cost averaging. Like if you keep buying, even if the market is falling, your cost keeps on reducing. And if you take a 3 to 5 year view, then you are going to make money. The mistake a lot of people make is that they buy and then they stop buying when the things are down 20, 30, 40%, thinking that they're going to buy when they decide when the bottom strikes. You will never be able to get to the bottom. It just doesn't happen. You have to buy it when it's at 100, buy at 70, buy at 60, buy at 40, and you can average it down to 50. So I would suggest that you choose a market, choose an asset, and you buy it because you like it and you want to hold it.
Manish, some of those inflation worries are also getting spurred by the pressure that the Indian currency is facing, and that's going to be a continued phenomenon from all accounts, despite the RBI's moves. How deep do you think that trouble may stand, especially when it comes to stocks that are import-oriented?
That is true. Inflation concerns you are seeing everywhere. We are seeing this in the UK as well. Our last CPI print was 9%. It is also, like we tend to get a lot more news these days than what it used to be in the past. I mean, the world and UK and everyone has gone through 20% inflation in the past, as you know, and it seems that the world has continued and humanity has continued. So there is going to be a lot of shout and cry about. Governments are going to do what it can, but we also know that the cure for high prices is higher prices. And if price continues to rise, then those inflation numbers are going to get quashed. And you look back in 6 months or 12 months time and think, well, what were we worrying about? I like to point out one thing, that if you look at the job growth or GDP growth, I'll just give you, bear in mind one number, and I'm sure this applies in many ways to India as well. And if you see in US, there are 2 jobs opening to every 1 person unemployed. What does that tell you? That the future growth beyond the inflation fear is robust. Now, that is not going to be in isolation, because emerging market plays an important role as well when it comes to not just feeding, in double quotes, the US market or European market. So yes, we will have problems, and governments will have to respond, and governments will have to throw away some of the fiscal barriers that they have and help the consumers. And we have to go through a cycle. But we are going to go through it, and that's what has happened in the past. And if the prices rises too fast, then it will automatically be the cure for itself.
Always a pleasure talking to you and getting your perspective, Manish Singh. Thanks so much
Vikram.
for joining us. Indeed.